and promoting integrity is one of the commitments that we made.
Good morning, ladies and gentlemen, and thank you for joining us for our first webinar of 2024. Now, this year we've decided to hold more regular webinar sessions, but try and limit it to only 30 minutes. And we really hope that you enjoy our first webinar for the month of February, which will focus on the economics of geopolitics. Now, later this month, we will also feature a legal and tax expert on some tax matters relating to investments as we approach the end of the tax season and given the upcoming budget speech. We know that you've probably attended a couple of these webinars already, where industry experts give their outlook for the year and possibly even some predictions. Now, we wanted to try and focus a bit more on the geopolitical side today and talk about some risks that we see for 2024 and even a bit maybe stretch out to the next 2, 5, and even 10 years from now. Now, the aftermath of the COVID pandemic and the ongoing Russia-Ukraine war has exposed cracks in societies, it seems. Last year, we missed the widely anticipated recession, and we remember words such as soft landing and hard landing being pretty much used on a weekly, if not a daily basis by market commentators. Political strife and violent conflicts such as the Gaza and Israel situation have captured the attention and apprehension of populations worldwide. Now, as we enter 2024, it seems that there's a bit of a negative outlook for the world over the short term when considering geopolitics. Now, the Global Risk Perception Survey, which did its annual survey in September 2023, said that majority of respondents, about 54% to be exact, anticipate some form of instability. Now, what is shocking from the report is that the negative outlook seems to worsen as you extend the time frame, with 63% respondents expecting only more turbulent times to come. Now, this may sound like a terrifying doomsday scenario, even the intro for another apocalyptic movie, yet it's not. And when we look at the current risk landscape, it is very interesting that the risks are material and real and felt by all. Now, when considering the survey done, respondents are most concerned about weather, misinformation or fake or false information, political polarization, and the strain then on consumers in the form, of course, of the cost of living crisis. Now, joining me this morning is investment analyst Wiehan Dul. Wiehan is here to chat to us a bit about the geopolitical risks and the landscape, the political landscape. Now, Wiehan, if we only look perhaps at some of this stuff that we've mentioned, like misinformation, political polarization, even the cost of living crisis, one could ask how these risks will be influenced by what is deemed by the biggest election here in history. I mean, nearly 65 countries will take to the poll this year. And let's maybe start off in this morning's session looking at specifically this chart, the GDP per all the regions having the elections. And what can you tell us about this chart?
Well, so here we have a geospatial plot of just, as Tanya said, all the countries having elections in 2024. And what we've done is we've created a color scale to sort of show the GDP per capita of those different regions. And what you can notice is you have the US on the left, obviously the richest country in the world per capita. And then you have Europe, a couple of the small countries in Europe also very high on that scale. Whereas if you look to the east, you have a lot less GDP, other than, of course, Russia, and Africa also much, much lower levels. But if you were to look at this plot at a different focus, if you were to just look at the population size of those regions, what you'll find is, well, the west is definitely the richest. The east is definitely the most populated. And given the current east-west divide, it'll be very interesting to see how some of the current geopolitical tensions rise in the narrative of the different parties and campaigners, going into these elections. And I think it'll be very interesting to see how the results of the elections influence policy going forward, specifically relations between the global east and the global west.
So maybe let's then talk about the East and start off with India. So you brought a slide along to maybe to share with us the economy of India, the international standing. So what do we see on this slide?
Well, India is currently one of the fastest growing economies in the world. They're projected to grow by 7% next year. A lot of that is due to business-friendly policies, different policy reforms, reduction in compliance burdens, etc. All of these are spurring an increase in foreign direct investment into the country, right? And you can see that from the stock market. So the stock market in India has overtaken Hong Kong to become the fourth largest in the world. So what you have is market participants really voting or betting on the growth in India because of these kinds of reforms. You see it?
Yes. And do you think this is also perhaps going to help Moody in the upcoming elections when we look at these GDP growth and infrastructure spending?
Oh, I think definitely. So a lot of infrastructure spending means there's more mobility of workers, more mobility of goods. The foreign direct investment coming into the country is leading to an increased wealth effect for citizens. So I think that definitely bodes well for Modi's chances going forward. India has also for decades practiced a policy of non-alignment, and what that allowed them to do is that they've been able to import a lot of discounted Russian oil, regardless of these kinds of sanctions. So it also means that their energy costs are low, petrol costs are low. All these things help sort of spur the economy to grow even further. And I think the electorate is very happy with the results that the current government has produced in the country.
Okay, so maybe then moving on to the next one, then Russia. So what can we expect from, firstly, perhaps the economic landscape in Russia going forward?
Well, given the G7 imposed oil sanctions to Russia, you would think the economy would be struggling a lot more than they are, and that's not true. One of the reasons is because demand for oil has shifted from Europe to African and Asian countries, so it's very much offset that decrease in demand. In addition, the sanctions for Western firms in the country has obviously led to most of them leaving the economy.
Yes.
That's opened up chances, opportunities for Russian businessmen. As well as the fact that capital controls don't allow them to necessarily move a lot of funds out the country. It sort of forced them to invest into the economy. So the economy is doing very, very well from that kind of standpoint. Whether the citizens are happy with the current environment is another question.
Yes.
The ongoing war in Ukraine, conscription, is really not something that people of Russia are very happy about. You've seen a lot of men fleeing the country into neighboring Azerbaijan or Georgia, for example. And I think that puts a lot of strain, obviously, onto the economy, losing labor force, as well as losing military-aged males that would otherwise work in industrial sectors like steel and oil, for example.
So we're going to move on to the US one now. So very interesting point maybe to mention is that the 5th of March is deemed Super Tuesday. But that's one of the major dates and events happening for the US in the upcoming elections. But if we move on to the economy per se, let's maybe talk a bit about that. I want to ask you, after you chat about this, maybe you can think about this question, but do you think it's going to be a clear Biden and Trump election this year? And where does Haley maybe fit into it? But maybe first off, start with the economy.
Well, the economy is doing extremely well, even though obviously there was a big expectation for a recession last year. And there's a number of reasons for that. One of the main ones is onshoring and nearshoring of manufacturing. So given the trade war between the US and China, there's been this big push by firms who sell goods in North America to nearshore their production. So for example, big companies are investing into Mexico, therefore cutting down the trade barriers that they previously had between China and the US, and especially because of the supply shock we find during COVID. But similarly, they're also onshoring in America. So you've seen a 60% rise in manufacturing construction in the States. This is a big injection of government spending into the economy. So that G is really lifting lifting the economy up. And consumers are also still very well off. So you also have a lot of consumer spending that's lifting up the economy. So when it comes down to, you know, Republicans versus Democrats, you see how close cut it was back in 2016, right? I think you're going to find that's going to happen again now. An interesting new piece of data I've seen recently is also that the amount of women that identify as liberal has increased dramatically. So you would find that most of them would probably lean more Democrat, while the amount of men who lean more conservative has also increased. So they might lean more to the Republicans and to Trump. So it's definitely going to be close again. Whether we see the same kind of tensions we did in early January, where we saw the, you know, what happened in Capitol Hill, I'm not sure about that. But I mean, things like the border crisis getting worse is obviously another big talking point. And you have Texas and a multitude of other states that are trying to actually close off those borders and trying to support Texas, who really started this, you know, this trend of closing off the borders that the Democrats opened. And that's also creating a lot of political divide. But regardless, the economy still seems to be doing well. And I think that will definitely continue into the future. And you can even see, you know, from the China-US trade war that export volumes from China to the US have dropped. But you also see the increase in manufacturing. But consumerism is still high. So that's really boding well for the US, removing all those trade barriers and those geopolitical tensions with other trade partners in helping spur consumerism and investment and government spending.
So you want to take a swing at that question of mine, saying whether it's the Trump-Biden all the way, or where does Haley fit into this picture?
I think you'll find that they'll be the main candidates. I mean, you've already had a lot of Republican nominees fall out of the race. I think a big question to ask is whether the courts decide that maybe Trump can't run, because you've already had one court say something like that, and Trump is currently in a lot of other legal disputes. So maybe that shakes things up. Not quite sure, we'll have to see.
And then international standings, maybe just the US support for Israel's invasion. I mean, that's quite an interesting dynamic also playing out.
Well, you also have a very big divide on the support for Israel versus support for Gaza. We're not talking about support for Hamas, we're talking about the Palestinian people, right? And that is really putting the US on the back foot, because they came in strong to support Israel, but now the UN has a resolution against occupation in the West Bank and in Gaza, and humanitarian crisis that Israel is really, you know, pushing at the moment. So that doesn't look good politically for the United States when it comes to the rest of the world. When it comes to Ukraine, I think it's also something important to talk about. I mean, the US has put $75 billion in since, I think, January 2021 into Ukraine, and there hasn't been any progress being made. There are also a lot of stories about weapons going missing in Ukraine, and that's not really good when you think about how the US might be then, you know, financing the black market. Maybe some of these weapons end up in the Middle East. You know, you also have tensions with the Houthi rebels in Yemen at the moment, and Iran, and you know, it's really quite a difficult situation they find themselves in. They might have to do a policy turn. We'll see. And that might also play into, you know, Republicans versus Democrats. How do the Republicans react to the backlash that Democrats are currently getting for their stance on the war? And we'll have to see how that plays out.
And then I suppose South Africa is also then, we're facing one of our biggest election years also coming up this year. And I mean, we can't really sit here and discuss now, you know, whether we think it's going to be a coalition government, or whether, you know, the ANC loses or not. We're not going to go into specifically that. So, but let's talk about firstly the economics in, you know, happening in South Africa. I mean, we've often said this, we need a GDP growth of at least 3 to 5% to get an unemployment numbers down. We see again the GDP coming out now downwardly revised yet again. So talk a bit about that and the concerns there as well.
Well, I think we all know that, you know, the electricity crisis and the freight crisis is really detracting from our potential GDP at the moment. That would need to be resolved before we find any kind of spur in growth at the moment. Because the thing is, it's leading to increased costs. Increased cost of business, increased cost of transportation, that's pushing up inflation. All these things are very negatively impacting us at the moment. Luckily, we have private generation capacity coming online, and that seems to be improving on the load shedding story. I think in the next couple of years, we'll find that we'll be at much lower stages than we've been. We've been at an average of stage 2 over the last 2-3 years, and it's been very volatile at the moment as well. And I think, you know, our stance, for example, on on the war in Ukraine, the war in Israel, and our stance, in siding with Russia and China rather than the global West is also causing a lot of uncertainty, right? So there's uncertainty that we'll keep trade deals like AGOA going forward. There's uncertainty, regarding the political foundation of the economy, because we're siding with, authoritarians and communist regimes, and how does that reflect on a young democratic constitution necessarily? And how does that bode for risk appetite in South African securities, for the South African rand? How might that affect inflation? I think we're in a very difficult stage at the moment. That the ANC is poised to possibly lose a majority, and the question is then who would they be in a coalition with going forward. And I think you'll find that if it's the EFF, for example, then populist policies will continue rather than business-friendly policies and opening up trade. So there's a big question as to what will the coalitions do and who will the coalitions be going forward. How will that affect policy that will affect economic growth?
So definitely a big year for South Africa and a big election.
Difficult year for South Africa, yes.
Absolutely. So, and then maybe international standing. Anything else you want to add maybe on the international standing for South Africa?
Well, like I said, we're currently choosing to side with the global East. And, our trade volumes with the global East compared to Europe and the US are very, very low. So do we start changing up supply chains? How does that affect, trade deals that we have at the moment? We get a lot of tax incentives. Not tax incentives, import tariff incentives by trading with China and Europe. Trading with the US and Europe at the moment. I think all of those are in question, and we'll have to see what the policy stance is going forward.
Well, then maybe it's good that you've now chatted about, you mentioned now topics such as the war, you chatted a bit about the trade. One other aspect coming in there is oil specifically, but it seems those three themes are actually the geopolitical disruptors. And then if we were to take those, you've prepared some slides to talk us maybe through stuff like rate cuts, potentially. Could there be rate cuts? Even small things like the rand and the impact on the rand. So let's maybe start off. I'm going to ask you to move on to this slide. Rate cuts. What are the markets saying about rate cuts? Is it pricing in a rate cuts? Let's start off with the Fed, the effective federal fund rates that we see here.
Well, the market is definitely pricing in rate cuts at the moment. So we can see from this graph here, we take the US 2-year Treasury yield versus the effective federal funds rate. And what you notice from the graph is that generally the 2-year tends to dip just before the cuts, right? So generally they move in tandem up to where the Fed might stop or plateau, and the 2-year will then tend to fall. And soon after that, the Fed funds rate tends to fall. And really what that is it's market participants pricing in those cuts. So they're buying up short dated treasuries to lock in a higher yield because they think that your cash yield is going to fall in the future. And now, depending on what the Fed stance is on the kind of data they're looking at, we'll see if the market is getting ahead of itself or if the market, being the bond market, is smarter than we think.
Now, often they say our MPC is Fed watchers and we keep an eye on what the Fed will do, but do you then think there's a rate cut on the cards then this year still for South Africa?
Well, so we tend to follow the path of US monetary policy because interest rate differentials tend to affect the rand quite adversely. So if the Fed weren't to cut, then the SARB would have to try to protect the value of the rand, and the rand has been very weak and volatile for the last couple of years. So it's likely that if the Fed doesn't cut, that we won't cut. And if the Fed does cut and our inflation stays sort of where it is or falls to 5%, but the rand doesn't recover, then there might be a little bit more pressure to keep interest rates higher for longer going forward.
So, the US sovereign bond pricing in rate cuts, but the labor market seems to still be very resilient and very strong. So do you think this will influence the Fed's decision to cut rates? I mean, you brought with this chart showing wage growth. What do we see in that labor market of the US?
Well, the first thing we must say is that unemployment's been at a multi-decade low, right? So you have a lot of employed people, but you also have a lot of open jobs at the moment. And what that does is low unemployment and high job openings means that there's obviously a lot of demand for workers, and therefore there's a lot of money in people's pockets. So what we can see from this graph here is our two things of the Atlanta Fed's wage growth tracker And then I have NFIB compensation plans. The NFIB compensation plans are small businesses in the States. They respond to a survey and they say whether their plans in the coming months is to either increase or decrease compensation, right? And what you see from this graph is that it tends to lead the wage growth in the States. And going forward, small businesses seem to be doing pretty well. You know, they have plans to increase compensation, probably to try and maintain the workforce they have, given there's so many openings, people are switching very, very quickly. And if you had to take the Atlanta wage growth tracker and you actually have different components, one of them is wage switches or job switches. Their wage growth is generally much higher than people who stay. So to be competitive, you have to increase your wage force, your wages of your current labor force. So this seems like it might push wage growth forward. And the Fed doesn't want to see that. The Fed doesn't want to see a positive wealth effect from wages leading to higher consumption and pushing up inflation. So this is definitely going to complicate the Fed's work going forward. But this is also why the US economy is doing so well, because people have money to spend and they are spending.
Yeah, but apart then from the payroll data, what else could actually then alter the Fed's decision making now?
Well, the Fed is also obviously looking at input prices, right? So we have producer price inflation that has been contracting for months, and that is a very, very, very positive outcome, and that's because supply chains have opened up a lot, right? Other thing to look at will be the Philly Fed manufacturing prices received. Now that's also a survey-based indicator, and all it asks is from manufacturers at the factory gate, are you receiving higher or lower prices? And this is the percentage. It's those receiving higher minus those receiving low. Okay. And at the moment we have less receiving higher prices. So there isn't this inflationary push at the factory gate. So producer prices are down, and survey data shows that it's staying low at the moment. It's below its long-term average. Because what this graph shows is its Z-score on the left. So its standard deviation moved from its average. You can see both of them are below their average at the moment. So that's a very positive outcome for the Fed, because it means consumer goods from the factory gate aren't necessarily inflating.
So it seems then that the factory gate prices are contained, but then what about the geopolitical tensions then on the supply chain? Could that not maybe just be another factor to consider?
100%. So I mean, if you consider oil, for example, right? Okay. In the aftermath of Hamas's attack on Israel, oil really shot up, but it's recovered since then. But then you had Houthi rebels attack an oil tanker in the Red Sea about a week or two ago. That also led to a spike in oil, but that's been contained again. So currently oil prices aren't pricing in ongoing conflict, but there's also a lot of other incentives involved. So one thing I want to mention is Saudi Arabia, for example. Saudi Arabia needs oil prices to be at $108 per barrel just to balance their budget. And we know that currently they're trying to build that massive city through the desert, right? That's going to take years to build and cost a lot of money. They need to make sure the coffers are full for that. So they've actually recently decided not to cut production, but not to increase it. They're holding it low to try and keep the price higher. So, whether it be the incentives of Middle Eastern oil producers or just the uncertainty regarding the conflict there, oil prices need to remain contained to keep inflation down, and there's a very big risk of it shooting out.
Okay.
In addition to that, I think what we have to look at here is freight prices, right? So the attack on ships in the Red Sea headed towards the Suez Canal have been forcing those ships to reroute around South Africa. This adds about 14 days to that transit. And what you find is from the graph I have here, you have the Baltic Dry Index, which is an index of the price to ship raw materials. And the other is the Shanghai Containerized Freight Index. Basically, that is a composite index of the cost of shipments from Shanghai to Rotterdam, to the US, to a lot of other areas around the world, and that's also risen recently. So the conflict is causing essentially the same kind of or similar kind of supply shock we saw in COVID, where these freight prices are increasing dramatically. And we have to really just watch to see that they're remain contained and don't shoot out too far. Otherwise, that's definitely going to have a negative effect on CPI, and it's going to have a negative effect on the Fed's decision to cut rates in the future.
But are there any caveats in the supply chain shock that we are experiencing?
Well, luckily for us at the moment, China is exporting deflation. So their export prices are down about 20% year over year. So even though the cost of the goods via transit via sea is increasing, the actual goods on the ships have deflated dramatically. Okay. The real question is, how does that affect the US? Because now, as we spoke earlier, the US is onshoring and nearshoring. Their trade volumes with China have dropped dramatically, whereas the trade volumes with China and other Asian, other African countries, especially, for example, Russia, have increased a lot. So it could be aiding certain regions a lot more than it does others. And again, how does that affect the Fed's decision to cut? We'll have to see. But luckily, there is some kind of caveat to those increased freight costs.
So, I mean, this brings us in a sense to a slide that we kind of wanted to put up to say that we understand as advisors, they often face end clients that sit in front of them with, they might have read newspapers, look at watch the news, typical media things. And I think the questions that often these clients would ask would be, if I could sum it up as being, will the rand continue to depreciate? Should I take all my money offshore? And then the last one would be, will we see interest rate cuts, right? So we've covered now a bit on the interest rate cuts. So I think it's quite evident that whatever will happen then in the US, our MPC will be sure to follow suit, and then we could potentially see that rate cut later this year. But I would actually just like to briefly stand still at the other two questions. Without being, trying to predict anything, but what could potentially happen to the rand? Do you think if we continue on this geopolitical tension side, that the rand will just continue to depreciate? And if, is there any, let's say, catalyst that could potentially see the other side, a rand appreciation? What would need to happen for us to go there?
Well, remember, from the view of foreign market participants, the rand and any rand-denominated securities are risk assets, right? So again, when the attack happened on the oil ship in the Red Sea, the rand blew out to about 1915, right? So there is that uncertainty as people or market participants find safety in safe haven assets or safe haven currencies like the dollar, you find the rand will weaken. So a protracted war in the Middle East and near to the Red Sea would definitely have a negative effect on the rand from a risk aversion perspective. And another thing we obviously spoke about the rand would be the policies, the African policies here, whether they're more populist or more business friendly. Again, it's more about risk appetite.
So a lot on the political front could also change and then dramatically impact the rand. So if we were to not see an ANC win this year, and perhaps, like you say, a coalition that's more business friendly, it could bode well for a stronger rand potentially.
Most definitely, yeah.
So there are some things that need to change for that. But then also on the offshore side, you don't want to necessarily sit here and be a pessimist right at the beginning of the year. And I mean, internally we always joke saying that Wiehan has the tendency to be quite pessimistic in the office, or realistic maybe rather. But should advisors consider taking more offshore? I mean, maybe talk about Regulation 28. It's already maxed out there. So what would your answer be?
I think the thing is not to overreact, right? Regulation 28 has already led to a lot of flows into foreign assets. I think South African investors already have a very big buffer, especially pensioners, in those allocations. So don't overreact. Don't take your money offshore now if you've already increased that allocation dramatically, right? Another thing to consider would be relative valuations. If you look at the US, for example, they're at a 95th, 96th percentile in terms of valuation. It's very expensive at the moment. Well, South Africa is really on the lower end, and EM in general is sort of on a 10-year average, right? So if you had to think about buying an asset at a good price, now is not the best time to be moving money out. In the US stock market is rallying, but you have so much concentration risk at the moment. The Magnificent Seven are 30% of the index. Let me correct myself. It's about 28% of the index. The maximum they reached in the dot-com bubble was about 32.
Yes.
So do you want to take that kind of concentration risk just because of an overreaction to the current environment we're seeing? I don't think it's necessarily necessary. Obviously it's client dependent, but if you already have a very large allocation, don't take more. I don't think that's very prudent given the current situation, given valuations at the moment. Yeah.
And I think, you did mention now the word overreact, and that's very important, very crucial, is that if you have a plan for your client, then you stick to that plan. And if that plan didn't entail now for you to increase offshore, then don't, like you say, overreact or even react now in a very volatile and uncertain time with elections happening across the globe in any case. And then, I mean, I think a lot of the older advisors that lived through the 2001 situation where the rand was very weak, but also offshore equities were very expensive, and then suddenly things just changed. I mean, the rand came back, I think, to 6 rand at that stage. So you don't want to have that, double up on that, where you put into more expensive assets and take out at a very weaker exchange rate.
What you must remember is that if these tensions were to subside, there would be a big risk on rally, and that would benefit South African equities and the rand. So, you might be overreacting by putting a higher probability on there being a conflict, but if there's not, you're on the wrong side of the trade. So I think you should be prudent in that kind of investment and stick to your plan, like you said. Yeah.
Wiehan, thank you. As always, very insightful chatting to you. And then thank you as well to all the advisors attending our webinar this morning. We really appreciate your attendance, and we look forward to hosting you again this month for our tax update as well. If you have any questions, please don't hesitate to make contact with us. We always upload the webinars to our YouTube channel afterwards. And so thanks again for attending. Goodbye.